How does a retail investor know when to cash in for some profits? Let's bring in CNBC contributor Michael Farr, chief market strategist with Hightower Advisors and president and CEO of Farr, Miller and Washington. Michael, always good to see you. So I was watching the movie the other day, Dumb Money, in which quite a few CNBC people appear. And it was really the story of the game stock or the meme stock mania back in 2021. And the big question, the through line that ran through the movie was, when do I sell? When do I take profits when I've made 10 times my money in some of these stocks? So when do you? When you've got a good profit, like my friend and father-in-law, Jim, who's had NVIDIA for a year. He's tripled his money. Should he sell?
Probably sell some, Tyler, and thanks for having me, of course. You know, selling is tough. And there's a great strategist, Don Hayes, old friend from Tennessee, who says you should be in a full body sweat whenever you make a buy or a sell decision. It should feel awful when you sell. It should feel awful when you buy. You saw Warren Buffett selling today some Apple shares. It's only 1%. But it's a sale. It's a taking some chips off the table. And I assure you, Mr. Buffett is following his discipline, as is the management of Berkshire Hathaway.
So what's your discipline? What's your discipline that tells you, for example, I know you have had a historic stake in Microsoft, up a lot. Yeah. What's your discipline for selling a stock?
We've owned Microsoft for a long time, and there are four ways. We have four rules by which we sell. If there's a change in our original thesis, if there's a change in valuation, if there's a change in if there's disingenuous management, or the overall first initial theory upon which we bought the stock, any of those changes will take us out of a stock. But that valuation matters. And there are two types of ways you look at that valuation. You say, well, the stock is 60 times earnings, and that no longer meets my discipline. Or it's grown so steadily, as in the case of Microsoft, that it's now such a huge portion of my portfolio. If that's the case, and you have 10 or 12% of your portfolio, that would be a huge position for us. It would make sense to lower that risk. So you create a risk both in concentration, and you can have risk based on price. Both will get me to sell. Some will just trim, as you talked about, managing the position. Others will have me sell the whole position if I really get concerned.
You know what's interesting is that your advice seems counterintuitive to, well, psychology for one thing, that if you're seeing the growth of something like this, if you see that, hey, I'm going to make 30 times my initial investment, but I'm not meeting the criteria that Michael Farr just laid out. Or, Michael, I don't know, like that thing about it feeling bad when you buy or sell, that's counterintuitive to following your instinct.
You know, Leslie, this is what Buffett has always said. Americans are funny. They hate stocks when they're cheap and they love them when they're expensive. And that's why you have to have a discipline. That's why you have to have rules that will protect you from your emotion. And when I say emotion in this case, I mean greed. If you think the stock's going up 30 times, of course you want to buy it, and you want to buy a lot of it. But anything that goes up really fast can go down really fast. And I was on CNBC back in those days when the dot-coms were going crazy, and in 07 when it was going crazy, and I preached this same message.
So let's take two stocks and look at them. Let's look at your Microsoft holding. Yep. Would you trim it? Are you trimming it?
I will trim it in positions where it has gotten too big. For portfolios where it's too big, yes. And if I didn't own any, Tyler, I'd buy some today too, because I think Microsoft for the long term, I love this stock. I think they're really well positioned, and I want to participate. So I would sell it if my position was too big, and if I didn't have a position, I'd buy.